Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for another edition of That's Our Two Satoshis live from a gloomy Los Angeles here on Tuesday. As always, for those who don't know, we've been talking, writing, and speaking about the digital assets market for almost 6 years now. We write a blog every week called That's Our Two Satoshis. It's on our website. You can find it at ar.ca/blog, where we go over everything that's happening in the market. And then we bring it to you here on Tuesday to talk about it. So before we get started, as always, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. Okay, so pretty quiet week in the digital assets market. We've been talking about this for 4 or 5 weeks now. It's been quiet for a while. You're seeing a massive vol compression, both in equities as well, right? The VIX is, up until today, when it started to move a little bit, but the VIX was hovering around year-to-date lows. Crypto vol hovering around 3-year lows. Feels kind of similar to early 2019. We'd come off of that 2018 bear market. Prices stabilized a little in January, February, March of 2019. Vol got crushed. And then all of a sudden we exploded higher in the second quarter of 2019, largely because of the announcement of Facebook getting involved into the crypto market. And everybody who was getting killed buying call options and sitting there watching vol go down ultimately made a killing on calls. Feels very similar right now, which is it's slow, it's boring. You're getting crushed if you own any kind of call options or put options because vol just continues to compress, but it usually doesn't stay there. Usually it reverts at some point. So we'll see. But that being said, it's pretty quiet. I mean, you can tell by the length of my beard here how quiet it is. I generally shave when we have a lot of client activity. Haven't had a lot in the last 2 weeks. People get an early summer, prices going nowhere, just a little bit of a stalemate here in the market. For the most part, this is where I think it gets kind of interesting. We wrote this last week as well, was usually when it's quiet, prices tend, in most markets, fixed income equities, prices tend to go higher when it gets quiet because it's expensive to stay short. There's not a lot of good reason to stay short a 5 or 6 or 7% coupon bond. It's not a great reason to stay short equities if there's no default scenario or negative catalyst. It gets expensive on the cost to borrow. In digital assets is usually the opposite, which is when it gets really quiet, people assume prices are going to go lower because quiet means there's not a lot of trading activity, there's not a lot of hype. What I find interesting, though, is that the majors here in digital assets have largely been fine. Even if prices dip a little bit, they go right back up. There just hasn't been a lot of leverage in the system, hasn't been a lot of real reasons to go down. We've completely just decoupled from the macro environment. 2022, everyone got tricked into thinking that crypto was a macro asset. It's just not, right? I mean, if you go back 6 years, 2022 was the only time there was any meaningful correlation between digital assets and equities. And now we're back to what it was like 2021, 2020, 2019, 2018, where we're really just tracking nothing. But what I thought was interesting was that this quiet period, again, not really a bad thing for the higher quality benchmark assets. Anything that has a real sticky community, anything that has real buybacks or burns or some sort of real revenue. But as Visual Capitalist pointed out, and we linked to it in our blog, Visual Capitalist put out a pretty interesting study talking about dead digital assets, those that have basically just died for whatever reason. And I thought that was really interesting because, if you have a company that is low on cash flow and ultimately bleeds through their assets, they're likely to file for bankruptcy. And there will be a court-approved process where there's an actual restructuring where the equity and or the debt will be deemed worth, nothing or something. And then you have a reorganized company. In digital assets, it doesn't happen, right? I mean, there is no bankruptcies for the most part of protocols and decentralized products. So tokens, in theory, can last forever. Even when there is a bankruptcy, things like FTX or Voyager, those tokens still trade. The FTT token still trades. The VGX token still trades. There's just no real reason for a token to go away. But as Visual Capitalist pointed out, there's 4 real reasons that tokens have gone away in the past. One is a scam or a rug pull. 2 is the token was issued just as a joke and served no purpose, so it kind of has a shelf life. 3 is the project just never gets any traction or gets off the ground in any way, shape, or form. And 4 is it gets abandoned by market makers and exchanges because it has no volume. And I think even though things like Bitcoin and ETH or even like your BNBs or your Uniswaps or your Polygons or even, Solana, things like that, even though those are doing okay, the larger kind of benchmark type tokens, I think there is a real risk right now for small to micro cap tokens because of those reasons 3 and 4, which is if the project never got off the ground, or it's abandoned by market makers and exchanges, especially with so many market makers and exchanges leaving the industry right now, you could see another real growth of dead projects. And the chart that we have in the blog, and again, I encourage you guys to check out the actual blog, showed year by year how many tokens have gone away. And 2018 was the biggest year. You had basically almost 1,000 tokens that just went away. About 40% of them because they were abandoned with no volume. Maybe another 200 because they were scams or rug pulls. Another 100 because they just gained no traction. And 2018, of course, being the end of a pretty significant bear market. So we haven't seen that many tokens go away in 2022. I think you might start seeing a lot of them just sort of die and go away here over the next 6 months. So again, pretty big risk to small and micro caps. Not a great risk to the larger, more established projects. You might even see a scenario where the overall market cap rises even as the total number of assets that are tradable shrinks. So we'll see, what happens over the next, couple of months here. But I definitely think you're going to continue to see a rotation into the large caps at the expense of others. Moving on, again, pretty quiet week last week. Wasn't a lot going on. But the one piece of news I'm sure everybody saw was that Tether came out with their first quarter results. Tether, $82 billion AUM stablecoin, one of the more controversial companies in this space. Almost nobody has no opinion. Everybody has some sort of an opinion, good or bad, on these guys. But I think it's funny. Here's a company in Tether that's been around for as long as pretty much any company in the digital asset markets. You constantly have hedge funds trying to short it. You constantly have the DOJ and the SEC harassing you. And how do you respond? By putting out a first quarter results where you print 1.48 billion in profits in one quarter. And they announced another $2.4 billion surplus above the value of the stablecoin, meaning they have to be backed 1-to-1 on the stablecoin. They've got a $2.4 billion equity cushion now, or about 3% equity cushion because of the profits that they've reaped here. And I think this is really interesting, right? One because there's always going to be a handful of people who don't even believe their results, right? They haven't been audited. Nobody actually believes the numbers. But it should be pretty easy to think about because this is a company that you give money to. Let's say you give $1 million to mint Tether. They give you $1 million worth of USDT, but they keep your $1 million and they invest it in short duration government treasuries, which are now yielding between 4 and 5%. So on an $82 billion asset base, if this was the most conservative company in the world earning 4-5%, you're talking about somewhere in the $3 to $4 billion range of profits annually, just by basically holding on to your cash for you. That's an insanely good business model. And the fact that people still are short in this company or still doubting this company is pretty hard to understand. I mean, this is probably the best company in crypto history that everybody likes to hate. And on top of that, you probably also saw that they're now going to be investing a portion of that $2.4 billion surplus into Bitcoin. And this is interesting as well, because again, why the hell would you do that? You have the easiest, simplest, most profitable business model in history just by investing in 3-month treasuries. Why would you increase your risk profile? And I think the reason they're doing this is not because they're trying to make Tether backed by Bitcoin. It's not because they think it really helps their net interest margin or their profits. I think it's because they understand that when Bitcoin goes up, it's good for Tether. They know that all of the people who care about Bitcoin also care about Tether. They know that when you increase your client's equity and you increase your client's trading activity, it's good for Tether. So it was an interesting move to do this because I think that's probably the bottom line here is that they don't care about improving their bottom line. Their bottom line is simple. It's easy. They're incredibly profitable. But their customers do care about Bitcoin success and do care about Bitcoin price going higher. And if you can put, $1.5 billion into Bitcoin every quarter with your surplus and make Bitcoin go higher and make your customers happier, that's great. In a similar vein, you look at something like Coinbase, right? I mean, Coinbase, as much as they have 700 different business lines now, but they still generate 95% of their revenue just from trading on the app. That's another example where Bitcoin has bonds that trade at 50, 60 cents on the dollars. It would be immediately accretive if Coinbase used, their $4 billion cash coffer to buy back bonds. They have a stock that basically goes down every month and has since their, not IPO, but their direct listing. That'd be pretty accretive if they bought back their stock. But they shouldn't do either of those things. If you're Coinbase, all you want to do is make your customers rich, because when your customers are rich, they trade more. So if you were Coinbase and you're sitting on 4 billion of cash, instead of investing in every other project they see that has had limited to no success, they should be buying back tokens, not just Bitcoin and ETH, but buy back some of the mid and small cap tokens, some of the ones that generate pretty healthy trading volumes for them. If they did that as a show of support for the market and its participants, it would eventually lead to higher revenues and higher volumes for Coinbase. So anyway, I think this is just really interesting as a story, in the sense that this is what good companies should be doing. They should be using the cash that they have, knowing that they can make a difference in their clients' lives, and use that to ultimately increase their own business. So kudos to Tether for doing that. I expect others to follow suit in terms of recognizing their audience and what drives their client success and ultimately their own success. So that's it for this week. As we kick off the week here, a little bit of a boost to crypto prices. We'll see if it holds throughout the week. But we'll be back with something insightful, hopefully next week for you. So that's our 2 Satoshis for this week. Thanks for joining. Check out our blog at ar.ca/blog, and we'll see you next Tuesday. Thanks, everyone.